Hello guys, in this video we are going to see Unit 7 continuity. If anyone not yet subscribed our channel, kindly subscribe, bookmark. First we are going to see about realization concept. This concept tells that exactly at what time we have to consider our profit as realized or earned. Okay, exactly on what date. If goods passes to the buyer and he becomes legally liable, okay, it means successful sale, that definitely you will receive money at any cost. Only at that case only your profit is considered as realized. No future income is considered. Suppose after a week you are going to make in sales of 1 lakh, 2 lakh, you may get in profit of 50,000. It can't be considered because it's future income can't be considered. Next, good sold on approval will not be included in sales but taken at cost only. Suppose a company takes a quotation from you. After certain period they send you acknowledgement that quotation is okay, we are going to purchase. Okay, this is means goods sold on approval but not it's sold. In this case you can't consider your sales is 100%, but you can take that cost only. Okay, that cost price you will receive. The rule of revenue recognition is earning process should be either complete or near complete. Complete, you know what it means, near complete. For example, suppose you are purchasing a product in EMI. At anyhow you have to pay every month installment. You are legally liable to pay. It's near completion. Next, dual aspect concept. This concept explains that every transaction has double effect. One is debit and other side is credit. If you are debiting any account, there should be some account should be created. Every transaction there is a double effect, very important concept point. Example, if X started a business, okay, if X start a business, in previous video we saw that business partnership, everything is considered as a separate person. It's an artificial person we saw. Okay, so here X is an natural person, business is an artificial person. If X starts a business with 50,000, okay, X is investing 50,000 in his business, then business has an asset of 50,000. This 50,000 somehow that business has to repay back. Business is liable to pay 50,000 to X because X only gave capital of 50,000. So it is liable to pay. From this we can confirm that asset equal to liability. This is main equation in accounting, asset equal to liability. Application. Every transaction has to expect, okay, the accounting equation is asset equal to capital plus liability. So here they mentioned capital. Capital is also a type of liability, but why they written like this means to differentiate that capital liability is how much and other liability, outside liability, is how much. To make this differentiation they wrote asset equal to capital plus liability. Next, historical record concept. In account, usually past things will happen again. For this purpose, we will record everything in date wise. For example, every month we are paying wages. It's happening. Past things is happening. Last month also we paid wages. This month also we are going to pay wages. Okay. Every 3 months once we are going to purchase raw material. Previously we purchased, again it's going to happen. So historical things will happen again and again. But the purpose of writing down the with date wise is, suppose after 6 months or 1 year there is an huge expense. At that time we can't be able to arrange the money. So by maintaining an historical record concept, we can able to know after 6 months or 1 year, 5 year, what expense we are going to meet. Based on that we can arrange the fund from now itself. Next we are going to see about going concern concept. Going means it's continuous. If you are planning to start a company, your intention is to run your company long term. It means it should be continuous process. This is known as going concern. It should be going on. Okay. If an expense is incurred and utilized during the same period, same year, it is known as expense. Otherwise, it is known as asset. Suppose you are purchasing an machinery of worth 10 lakhs. You are spending 10 lakhs this year, but you are going to use that machine more than 10 years. Okay, you are utilizing more than 10 years. Beyond that years, beyond an year, you are going to utilize. Then it is known asset. Suppose you are purchasing some stationery, it is utilized within a year, then it is known as expense. Application. We know, as we saw earlier, fixed asset are valued at cost, not in market value. Depreciation should be provided based on the number of useful years, and reserves and provisions are created for future liability. Accounting period ends on March 31st. Suppose you have to pay something for March month dues on April 1st week. That liability should be mentioned as reserve and provisions. Next, deferred revenue expenditures are written off over a number of years. What it means, deferred revenue expenditure? If you are going to make some expense, from that you are going to make any profit in future in deferred manner. That means profit, you are going to get some profit this month, after 6 months you are going to get another part of amount. It means, there is an example. Suppose a company made some expense to place a banner in road. Okay, in main road they are planning to place a banner. It may be worth of 1 lakh. It is an expense. At that time, if anyone seeing that advertisement, it is in marketing, your product will be sold out. From that you are going to make some revenue. That revenue you will get based on how much period that banner is placed there. Suppose 5 years means 5 years you are going to get in revenue. This year some revenue, second year some revenue, third year some revenue. It is known as deferred revenue. In this case, that expenditure should be written off over a number of years. Suppose you are spending 1 lakh to place a banner. That lifetime of the banner is 5 years, means that 1 lakh expense you should not mention in first year. You have to divide by 5. Every year 20,000 expense. Like that you have to maintain in your accounting. Next one, life of the business entity to be infinity. Okay, going concern. Next one, matching concept. This concept explains certain period. You have to choose 6 months, 3 months, or 1 year. Certain period you have to match the income and expense account. Something like you are matching debit and credit to make tally whether everything is correct or not. Suppose if you are making a payment without knowing, you made double team the payment, you can able to find out at this time. Some irregularities in debit or credit you can find out. So matching concept is very important. All adjustments regarding prepaid expense and outstanding expenses, this one we can't able to match, so we will make it in a final account. Deferred revenue expense concept arises due to this concept. Okay. Next, accounting period concept. Usually we will do accounting every 12 months. Okay, 31st to March we have to release that company accounts, so that only investors and public will know about the financial status of the company. Every business will consideration run for a long period, but there will be a specific company we can able to declare their result only after they cease to operate. It means after that the asset sold off, liability paid off, then only we can able to say exactly what the financial status of the company. But investors or public will not wait for that. So for that we are making accounting for that company short time period. For example, every 3 months they need to provide their accounting statement, 6 months likewise, because we can't able to calculate perfectly like 1 year accounting period. For that purpose we are doing short time period. This 1 year is for external reporting, but the firm for the internal purpose they may do some internal reporting purpose, they may do accounting 1 month, 3 months based on their requirement. Okay, that accounting period concept uses, what are the uses? Comparing the financial statement for different period, we can compare Q1 and Q2 like that. And then uniform and consistent accountancy, so that we can able to find out what is the profit and what is the asset of the business. Matching period revenue with expense, so that we can able to get the correct result how the business operation is going. Next, main convention of accounting, and in this convention of full disclosure, we should disclose everything. That account must honestly prepared and all material information must be disclosed. Material information means what are the asset, machineries and everything, all material information should be disclosed. The Indian Company Act make a provision that it should contain a balance sheet and profit and loss account. There is a practice which is known as appending notes. Appending note means some additional information you will keep at last, relating that some of the items or facts we can't be able to include in balance sheet and profit and loss, so we are making these appending notes. Some of the example are contingent liability. Liability means you know what is mean by contingent. It is not a liable until a problem occurs. There is a good example. If you are making a guarantor for your friend to take a loan, you are not going to repay his loan amount until he refuses to pay. There is no problem for you. Suppose if he refuses to pay, then as a guarantor you have to pay. Okay, this is known as contingent liability. It is not liable until a problem arises. Next, market value of investment. Next, convention of materiality. All material information should be recorded. Okay, How you will find it, this one is material dependent or not? It is based on value of item involved. For example, paisa is not recorded because it has no value. Application: the account does not record insignificant item like paisa. Okay, and then based on the size of the business, we will consider it is material or not. See, they given some examples. For example, a paper stapler is 30 rupees only. Okay, if you purchase that paper stapler, it lifetime is, for example, 3 years. Okay, you are making some expense 30 rupees, but you are utilizing it after a year, which is known as asset, as we saw here. Okay, in this case, you can't consider that paper stapler as an asset, and you can't write in book of accounting that there is an asset 30 rupees stapler, like that you can't be able to mention. It is useless. So in this case, even though it is utilized after a year, this is considered as an expense. Okay, and one more example they given, that if you are purchasing an stationery items but there is still some part in stock after a year, you can't be able to consider this one as an asset. Okay, so you should have some common sense where to draw a line between material and immaterial based on the person who is there, their common sense only, which thing should be considered as material thing and non-material thing. Okay, and then convention of conservatism. While recording transaction, all possible losses must be taken into consideration, while all anticipated profit, it means all possible profits should be ignored. See, in this we are taking only worst scenario. This is called principle of prudence. Application: provision for doubtful debts. There is some debt, it may be doubtful, you create a provision. Creation of contingency reserve. We know what is meant by contingency. Until a problem arises, there is no issues. Value the stock in hand. See, suppose you are having some stocks here, we have to make a lower value either in cost or market value, which is having low value, that one you have to take. If you are having a joint life policy, that one you have to mention surrender value only in balance sheet. In convention of conservatism, you are taking only the extremely worst case only. Okay, thank you for watching video. If anyone not yet subscribed our channel, kindly subscribe, bookmark.